This spreadsheet is going to help us calculate foreign currencies. One of the most difficult parts of calculating foreign currencies is understanding the perspective. What I mean by that, it depends where you're standing. If you're in the United States, a direct quote is the currency per US dollar, where the indirect quote would be the US dollar equivalent. If you're in another country, the direct quote would be the US dollar equivalent, and the indirect quote would be the currency per US dollar. So this is very important to keep in mind when trying to price foreign exchanges. Let's take a look at the spot market. If we're using direct quote for US dollars, right? So we go back up here, direct quote US dollars, we would use currency per US dollar, which is here, currency per US dollar. That would be the spot Monday minus the spot Friday divided by spot Friday. We can change these days to whenever it is, and the calculations would be the same. So here's the calculations. For this set of numbers, we would have a slight appreciation of 0.4%. Now, if we were using the indirect quote for the US dollars, we would use the indirect quote. Now, we did get these numbers here. If you look over here, sample data. So here's where we're getting these numbers from, and this is pretty typical of something that you might see. And that's in sample data, sample calculations, and then calculations. Because this is going to change, but the other two frames won't. Just so we're using the indirect quotes for the US dollar. Let's go back up. Indirect quotes for US dollar. So that would be the US dollar equivalent, and that's what we have here. So we would use the other numbers. So let's see, US dollar equivalent. See? So for the US dollar equivalent, we would be using these numbers, 0.9107. So that would be the US dollar equivalent, and we would just fill in this, and it'll do all the calculations for us. These two pages will be very useful. I definitely recommend you study from them. For other currencies, we have the US dollar equivalent, which is opposite of our US dollar equivalent. So for a direct quote, it would be the US dollar equivalent for a foreign country. The indirect quote for a foreign country would be the currency per US dollar. Again, we fill in all the fields, and it calculates our percentages. So we have here, using indirect quotes for other countries, we have the currency per US dollar. See how that works out, right? Foreign indirect, currency per US dollar. Indirect, currency per US dollar. We fill in the fields, and we have our calculation. Forward market is a price that's in the future. Same thing, using direct quotes. We're going to have a group of percentages. Using direct quotes, we fill in our fields here. The forward rate minus the spot rate times the spot divided by the spot rate multiplied by time will give us our quote appreciation. In some cases, depreciation. This one happens to be a discount. Using indirect quotes for US dollars. This is the US dollar equivalent. Indirect quotes for US dollars. So where is that? Indirect quotes for US dollars. It's the US dollar equivalent. Does that work? Indirect quotes for US dollar is the US dollar equivalent. So this way we can get a real idea of perspective, because that's really the hardest thing to get over when we're working with foreign currencies. Basically just fill in these fields for the rest of them, and that's how that works. Forward market, same as the spot market, except it does some different calculations. It has a forward rate, spot rate, and it multiplies it by time. The bid rate is a currency's broker's buying rate. The ask rate is the currency broker's selling rate. Bid rates are always lower than the ask rates. So over here we have a bid-ask spread. It's a basic calculation. And that's the bid-ask spread. If we went back to, we found that, 9038 and 9115, bid and ask. 9038, 9115, bid, 9038, 9115. That's our bid-ask spread. Cross rates. Very common. It's an international world right now. It's a globalized world where we have cross rates where we exchange currencies that aren't exactly US dollar, except these currencies can be exchanged, maybe a Swiss franc to a euro. The cross rate would be expressed as B per A. If currency A was a franc, the currency B would be a euro. The cross rate would be expressed as francs per 0.14, 0.014 per euro.